Hey everyone, this is Michael Bengiat. This is the Stock Picks weekend video for May 21st, 2022. What I want to do today is we'll go quickly through the current market environment, which of course is, we're in a bear market. We'll go through real quickly the stocks in their watch and ready list, which are very few. And then I want to just go through quickly some of the sectors and go through some stocks, just give you a good overview of what's going on under the surface. So let's go ahead and get started. Here's our disclaimer. You can pause the video and read this. And let's go ahead and get started. So here we are. This is the our last note for Friday. And we had a little bit of a late day reversal in the indexes, but we're in a bear market. We have our trading environment is still red. The current best strategy is just stay out of the market, and we have no exposure. We haven't any positions on for any while. And really, this has not changed. It's an ugly bear market, especially underneath the surface with, all the traditional names that have been strong. They're all broken down. We're going to look at some of those in a minute. And there's very few that are holding up. And one of them is MERK. We're going to show that in just a second. But there's just not enough strength in the market to really even. We were tiptoeing our way in for months and just didn't work. We'd get a little profit, and unless you were just, sometimes you got enough profit in a day and then you had to take it before it disappeared the next day. So I'm going to pause it just for a second. I'll come back with the charts. Okay, so let's go ahead and start with the only stock on our growth stock ready list, and that's MERK. And it's acting pretty well. It's just one of a tiny handful that are acting well. In fact, you can look at the relative strength line. It's just screaming up, just showing how it's outperforming the S&P, which is this black line. You can see as it's been going down, this has been going up. In a normal market, we'd be all over this, especially after this little tight area here and it broke out. That was a nice buy there, and really it just wouldn't have tested as much. But this is like one of the only stocks that's really doing this. It's very, very few. Even the oil stocks the breakouts, they're still heading higher, but they're sloppy. There've been big corrections. It's been very hard to get in any of them, and they're not giving us really any spots to buy for the most part, or they've been failing. So anyways, this is what we look for. Look at this outperformance. If this was starting a bull market, say we already went through this whole thing, and then we started seeing this forming after a huge decline in the whole thing's washed out. We'd be buying this in a big position here, because this is showing that could be one of the big leaders of the next round. But at this point, we're still in the middle of this pullback and correction in bear market. So we're going to sit there and just watch it. So let's go to our few stocks we have on our watch list. We just have 3, and 2 of them are actually shipping stocks. So it's interesting that we like the fact that we see more than one. It could be that the group is starting to set up. In fact, we'll take a look at that in just a second. But it's been a choppy trader, so we really haven't, it's been sort of off our radar because of this chop. It's just up and down, up and down, up and down. And it's starting to tighten up a little bit here, but it's also widened. In fact, if you look at this, let's see if I can draw a line. We sometimes call this the megaphone, where instead of it going tighter, we're getting this. So it looks like a megaphone. And we don't want to see that. It means we're getting more volatility. Also in this one, we have earnings in just a few days. So we'll probably just stay away. So it's on the watch list. But you can see the RS is 99. It's outperforming basically most stocks in the market. As strong earnings, strong sales. Again, in a better market, this would be something we would be looking at. So let's go to USO. This is actually an ETF, or it's an ETF it's corresponding to the spot price of oil. And this one, again, you look at the outperformance on the relative strength, and look how this is tightening up. This is actually great action. And so we have a buy to buy it right at, let's see, where's our buy? 82.60. Yeah, it's a little tricky to see it here, but we're right around there when it breaks above this area here. And as an ETF, you're kind of getting more of a exposure to not just one stock, but the whole sector. So that's looking pretty good. We love this kind of a pattern. And even if it gets the final day, if it gets tight and it's kind of an inside day, that would be great. Also, you can see as it's been going higher, we're not getting any big volume spikes of sellers. So the sellers are not really very active right up here. So we're not getting that resistance and that overhead supply where we've seen in the past. Now we are getting this when it hit this peak, sellers came in, so there will be a little resistance here. But and ideally this will just break out and head straight past that point, kind of avoiding all that. So we will be just watching that. And then the last one is EGLE, bulk shipping. Another one, kind of choppy. So this is just something that we're watching, but you can just see the outperformance in these stocks. They're all really high RS. We're all 98 or 99, and just showing very good outperformance versus the market. Over here, you can see the earnings. They've really just shot up from just low single digits to mid-high double digits. Even though next year's they look to come down 22%, but all in all, it's just very strong earnings and sales. So this one, again, we'd love to see this kind of tighten up. If the market gets into a better situation, we would love to buy that. So that's really, there's just really not much. And none of these are really super. I mean, the USO is the only one that really has a nice pattern. So let's go ahead. I'm going to go quickly through some stocks in different sectors. These are a few of the things I've been looking at. Cigna is another one. This sector has done pretty well, but very good RS line coming up, but it's been very choppy. So these are not really in any order, so I'm just going to kind of go through. Here's the QQQ, just for anyone who hasn't been really looking at it. We're just making new lows. Let's look at the weekly. Yeah, we're just breaking down. The RS is 38 now. Let's go to the next one. This is the transports. The transports broke to new lows. Again, this is a nice move, but we're starting to give it all back from the March 2020 bottom. We still have ways to go, but this is an ominous sign that we're just heading lower and lower. And then one of the things that there's a school of thought called Dow theory, where for the market to be healthy, we should have the transports and the Dow industrials move in the same direction because they represent supply and demand. And we're both getting them breaking down, so it's not a sign that we really want to see. Let's take a look at the consumer staples. Now these areas like this, consumer staples, you're getting, usually these are defensive. Well, they are defensive areas. But normally, when the market's going into correction, these are really just heading higher and higher. And you can see just until recently, this was making new highs, and now they're all starting to break down. And we've seen Walmart and Target and some of these companies that are kind of the stable ones just starting to break down. Here's one. Church and Dwight, they make baking soda, laundry detergent, stuff like that, toothpaste. And look, this just sliced straight through its 200-day, the black line, really not showing any strength. Here's another one, Procter & Gamble. Same thing. These stocks should not be breaking down in this environment. So under the surface, this is really not a healthy market. Here's the XLE. That's the Energy Select Spider ETF. Again, this really is one of the few ones that's heading up. This one we would try to maybe get in again, though we're getting pretty extended. It's up 100% just from September, but we're watching that one. The OIH, that's the oil services. This one's starting to break down a little bit. We're below the 50-day. It's not so great. The financials, this is the XLF. Yeah, we're in a downtrend now, where all the moving averages are starting to head lower. So not strong. Steel, this was a very sector that was doing really well, just unfortunately in the last 6 weeks or so, it's starting to break down. We're below the 200. Like U.S. Steel, this was a great performer last year. You can look at the powerful move, and it's just giving it all back now. So there's not a lot of places that the market's hiding. Let's take a look at here's some of the worst. Peloton, let's look at a monthly. That's just giving back the whole move and more. So that is just very bearish. Zoom, this was the market darling. It's almost completely given back everything since its IPO. Here's one, Lemonade. This was a property insurance kind of disruptor. I think Kathy Wood of the ARK funds owns this and has been buying it all the way down. Looks like it wants to bottom here. We're getting some sign of a capitulation maybe, but we don't know. I mean, this company is just losing money. Some of these will go bankrupt. That's just how it works. Great ideas, but we know if interest rates are going up and hedge VCs, venture capitalists are just pulling back, which we're starting to see. They won't be able to get as much funding, and we are starting to see a lot of layoffs in some of these types of companies. We're also down 82% from its 52-week high. So, a lot of the employees too, they just get disillusioned. They were thinking they were going to get wealthy with stock options, and they're not. Most of their stock options are underwater now. A few more. Netflix, big market darling, broken down. The home builders, this is another one. Look, it's just hugging a downtrending 10-week moving average, this weekly chart. Not a sign of health for the economy. Here's Target, just completely broke down. Walmart also. Now these are usually just pretty stable. So there's a lot worse going on to the surface. Even Apple is starting to break down. And basically everybody owns this. I'll take a look at owners and funds. They have 6,200 funds own this, and it's just been increasing since June of 2020 by another almost 1,000 funds. All these ones that have come in late, or their positions at least that they've been adding, are now all underwater. So it's just, in fact, if you look at their sales and earnings, let's drop this down a little bit. Look, their sales, 54%, but 36, 29, 11, 9. That's not what you want to see. You want to see increasing sales, and the earnings are also dropping. So it's likely that Apple is not going to be one of those stocks going forward that's going to give investors that outsized return that they've seen for a long time. Look at a few others here. The NASDAQ, which of course just is breaking down. This is a weekly chart. It's giving back a lot of the move from 2020. PayPal, another one, just getting demolished. Here's Amazon, another one. People thought this can't go down. This could never go down, 20% or 30% because they've taken over the world. Well, we're off 43 from the 52-week high. I don't even think that was the high, the all-time high. Here's the ARK funds, the one Kathy Wood's fund, down 68%. If it was even lower over here just last week. Burlington Stores, another retail store. Look, if you start looking at the theme, here's John Deere, tractors and harvesters. Different sectors representing different sectors of the economy. Tesla is breaking down. And why is this happening? This is the 10-year note. Interest rates have just come screaming higher off of basically zero. Here's the 5-year. Let's close this. Come on, go away. There we go. That's come back to where we were in 2018. So the fact that it's going up so quickly, it shows how far the Fed was behind the curve, and now the market's forcing them to raise interest rates. Here's the 20-year Treasury bond. I won't really comment on that one. It's just been going down and down and down too. So I think that's all the charts I have here. So you can see we're just not in an overall market environment that's conducive to making money. Almost everything is going down. There's very few pockets of strength, and even those are really not acting all that well. So really the lesson here is just, cash is king. There's no reason to be in the market. You shouldn't never be bottom fishing these stocks. Let's go back to, let's think Lemonade. There's so many people are buying this all the way down. I mean, we can just look at this here. Here we came down. It looked like it bottomed here at 58. We had a nice rally, but it came down and eventually it failed. It broke 58. Now we're 21. But this was the bottom. Oh yeah, that's the bottom there. And the bottom fishers keep coming in. Every time it would make a dip, but look, it just keeps lower and lower high. I mean, lower and lower lows. Sorry. So There's a higher low, then lower, then lower, then lower, then lower. Even look at some of these moves. This is 16 to 30. That's getting close to a 100% move, and then it just fails. So and look at this. Every time it comes up to the 50-day, it just hits resistance and comes down. Now it's starting to flatten off, so we might be getting eventually maybe another rally. But there's no reason to be buying these things. You don't know where the bottom is, and for most people doing this, they every little dip. This was the bottom they bought. Oh yeah, this can't go any farther. This is a fantastic company. Even this one. Oh yeah, that's it. That was just a shakeout, a little correction. Now I'm back in it. No. So anybody who bought it, except for these few people over here, they're all underwater. In some cases, 40, 50, 60%. So you don't want to be one of those traders. You just avoid these stocks. When they set up finally and form some kind of a base, they've already made a bottom, that's the time we'll start looking at them. But we never buy these things. That's a falling knife. You'll lose your money. You'll lose most of your money doing this. And worse, it teaches you the wrong thing to do. It's actually worse if you bought one of these and had a huge move and then maybe you were lucky to even sell it. You go, wow, I made 100% on that. So now that just emboldens you to do it again. And eventually you'll be the guy who bought this bottom, and then it just on earnings or whatever news plunged, and then you find yourself down 50% overnight, and then you have a dilemma, what do I do? And then a lot of people, of course, don't want to sell, and then they just keep going down and down and down and down, and before they know it, they're down 90% from where they bought, and now they've lost all their money. So we don't ever do that. You never want to be in this position, where you're just bought incorrectly and now you're stuck with something that's just falling like a knife. So that's about it for this week. We'll just continue to look at the market in various angles over the next weeks. And I'm sure we'll probably get maybe some kind of a bigger rally coming up. The market's very oversold, and it's probably overdue for a fake out rally. It'll make it look like the bottom's in and we'll come screaming back. But just from our market trend advisory, look a little more depth into the trend, and I'd say it's likely this is going to be a much more extended bear market. So anyways, we just have patience. Eventually, markets will bottom, and there will be absolutely fantastic buying opportunities like we saw in 2002, 2009, in March of 2009, that will really be sustainable and long-term, unlike what we've been seeing recently, where if you didn't take your profit within 2-3 days, you lost it. So anyways, that's it. We'll be back next week with more. Okay, thanks. Bye-bye.